Okay, good morning and welcome back, everyone, to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at Options Play, and equity markets have pushed to new all-time highs. At least the S&P and the Nasdaq 100 has pushed to new all-time highs. But we recently have seen the Russell 2000 and the equal weight S&P 500 start to struggle a little bit and not confirm these new highs. So this is the first sign since the October 6th election result where we've seen equity markets kind of push to new highs, but start to show a little bit of hesitation on these new highs. So we're kind of reaching what would be classically considered as overbought, and some markets are starting to show a little bit of hesitation, a little bit of pause on this equity rally here. So as you can see, the S&P 500 making new all-time highs, pulling back a little bit, even though it's still above those previous highs. And the Nasdaq 100 recently confirmed those new highs, which is generally speaking a bullish signal here when you have two major market indices print new all-time highs and confirm each other. But like I said, small caps is really kind of the part that's starting to fall back a little bit behind. In 2016, when Trump first won the first time, we saw small caps being one of the strong outperformers in that particular market. Right now, starting to lag behind a little bit here. And same thing here with equal weight. Equal weight also pulling back here, pulling back below that previous high. So we're starting to see, a little bit of hesitation here in equity markets, taking a bit of a pause here on that rally. This is the first sign that, at least in the short run, we could see a little bit of a short-term pullback here. But overall, long-term, things still look fairly positive. You see growth outperforming value by a pretty significant margin here over the past week or so. Commodities continuing to moderate. Gold and oil, predominantly oil at those 52-week lows, dragging commodities lower. But overall, if you look at the bond market here, you still see high yield corporate bonds print new all-time highs, uh, effectively putting on a risk-on signal here that the bond market is clearly not concerned around interest rates and concerns around credit risk, which certainly provides a bullish backdrop here for equities. And then you have the VIX. Yesterday, pushing a little bit higher here, but still trading near 6-month lows in that 13-14% range here. Still in this environment, I think still provides an opportunity for options traders to be long volatility, long options in this type of market environment, regardless of whether you have a bullish or bearish outlook here in the markets. Those long volatility options give you the ability to take advantage of um, a move here in either direction while options remain relatively inexpensive. You do have the 10-year yields tick up a little bit here yesterday. Above that 4.2% level, we're moderating around 4.2, which is a pretty significant pullback here from the 4.5 level that we saw here just a few weeks ago. So right now, interest rates still largely providing a bit of a bullish backdrop here for equities, unless we start to see another run here um, in in 10-year yields, which we have the inflation print here later this week that's going to provide some insights there with regards to what the Fed rate policy will likely look like in 2025. Right now, we have about a nearly 86% probability that there's going to be a 25 basis point cut here in December, especially after the labor market coming in pretty strong here at the end of last week, giving Chairman Powell, some room to wiggle with regards to how long he wants to wait for further rate cuts here. And inflation is definitely going to be one of the primary data points he's going to be looking at here to make that ultimate decision here for December and then for the beginning of next year. Um, you have bonds continuing to rally here off of that $90 support level here, continuing on higher. And you have Bitcoin, I'm sorry, the dollar index, kind of settling between 106 and 107. That's kind of a pretty tight range bound level that we're currently paying attention to here on the US dollar is between 106 and 107. And as long as interest rates kind of stay in this level around 4.2% level on the 10-year yield, I expect the dollar will likely continue to trade range bound in that tight range unless we get a breakout one way or another in terms of interest rates at the moment. But overall, interest rates are continuing to trend lower. That would indicate a potential break below 106 and the potential test below 106. Bitcoin still hovering around that 97 mark here. A lot of interest, obviously, in Bitcoin, but largely over the past 3 weeks or so, Bitcoin hasn't really moved much. So we'll do a little bit of Bitcoin options trading content here in the next couple of weeks here to kind of walk you through some of the options that you have to trade options when it comes to Bitcoin and kind of covering that for you so that you have a better understanding as to how you can potentially speculate on Bitcoin utilizing options. Gold, as you can see, continues to moderate here around that 50-day moving average, which comes in just shy of 27,000, 2,700 on gold. And then oil, so far kind of bouncing a little bit off that $67 52-week low level here. We'll see if this can continue to hold that level or if we start to crack below that level. A crack below that level would certainly continue to force commodities to tumble. And then looking at the individual sectors here, we're seeing, the sector, we haven't seen a lot of sector rotation. We've basically have seen the leading sectors continue to lead, and predominantly that's across three sectors, even though technology is starting to catch up a little bit here. Still overall lagging behind, but consumer discretionary, as you can see, a significant amount of outperformance here over the past few weeks relative to the S&P 500. Communications, same thing, significant amount of outperformance relative to the S&P 500. That has not changed. And also financials, we've seen a significant amount of outperformance, even though it's started to lose a little bit of that ground here over the last week or so. But overall, if you look at from a rotation perspective, those are the three sectors that have been leading the markets higher, and there really has been not much rotation. And on the flip side, you see the same thing, consumer staples, a fair amount of rotation out of consumer staples over the last few months, a considerable amount of rotation out of healthcare over the last few months, considerable amount of rotation out of materials over the last few months. Those are the three sectors that continue to see a fair amount of outflow. We're not seeing a lot of rotation. We're not seeing, lagging sectors kind of get back to leading sectors starting to fall back below. And that, is not a particularly healthy market to be in. So, that's definitely one of the things that we will be paying attention to here. Real estate also losing some ground here. Um, and probably the most important one to look at here is semiconductors. As you can see, semis, after losing a fair amount of ground here over the last few months, seemingly have stabilized a little bit here over the past 3, 4 weeks. We'll see if that can continue. It's still trading below that 50-day moving average, which means that it still has the propensity to potentially roll over here and break below that 210, 215 support level here. A break below those levels would certainly be bearish here for the semiconductor industry, which has obviously been a primary driver of growth over the last couple of years. If this starts to fall further behind, that certainly puts also the overall rally here in a bit of jeopardy here. So those are some of the things to pay attention to right now with regards from a macro perspective. And then, what we want to do is spend a little bit of time, during these sessions and really walk you through our overall thoughts in terms of ideas here for the week. And one idea I want to point out here is Alphabet. As you can see, it really kind of recently uh, after struggling here for the past, call it 6 or 7 months here, because, this was a $170 stock back in April. It's now $170 stock now. So the stock really hasn't gone anywhere in the last 6 months. But as you can see, it recently has After struggling a little bit, started to form a little bit of a positive tone here to the market. You broke out above 167.5, came back to retest this as support, and is now bouncing higher here. And I think that it has the opportunity to resume its move back up to around 190 or so to the upside, would be our upside target. And with all of these ideas that we present, our primary goal is to minimize or rather maximize risk to reward. So meaning how much potential reward do you have if it reaches your target price versus how much risk are you taking on? How far does it have to move against you before we can say, hey, this is not working out, let's get out and move on to the next trade. And what we're trying to do is find setups where we're maximizing that risk to reward ratio as far as possible in your favor so that when trades do work out, your upside is fairly substantial, and when trades don't work out, your downside is as limited as possible. This means that you can structure option trades around that. You can trade the equity itself. These sessions are really designed to provide you with the ideas so that you can decide for yourself what's the right product to trade, whether you want to trade the underlying itself or you want to trade an option like buying a call option or selling a spread here on Alphabet. Another one I want to take a look at here is Arista Networks. This is one that we added here in the last week or so. This is the stock that recently broke out to new 52-week highs, and we're really simply looking at this as potentially a continuation higher here from that level. Broke out above that 105 all-time highs. It's pulled back a little bit here yesterday with the rest of the market, but overall, this is the stock that trades at a pretty significant discount relative to its peers, yet it's expected to grow substantially faster than its peers. So that's why, we have Arista Networks as one of the stocks that we really like at this moment. Another one we like here is Dexcom. They are in the continuous glucose monitoring space, medical devices. As you can see, after struggling quite a bit here, gapping lower from 110 all the way into the 60s, the stock has really spent some time bottoming and kind of forming this base here, and just recently managed to break out here above that $75 level here, and we're looking for that continuation back up towards 110. Again, trying to minimize the overall risk as much as possible while maximizing upside potential when we're looking for this from a timing perspective. Dexcom does trade at a premium valuation relative to its peers, but it is expected to grow substantially faster than its peers, and it is far more profitable than its peers. And for those reasons, the premium valuation that it trades at is justified, in my opinion, and it still has a fair amount of upside, especially as they start to turn around some of their global growth, especially since they've recently partnered with both Apple and Aura Rings, both very popular wearable devices, for their products to connect to and use them as monitoring devices. Another one to take a look at here is CoStar Group, and we'll continue to monitor this particular one pretty closely because the view here from CoStar Group was that we were going to break out here above that $80 level, or actually we added it when it recently broke out above that $80 level. We were looking for that support level to hold and for it to continue. It's obviously pulled back a little bit below that support level here at the moment, so that's why we're monitoring this and seeing if that holds these particular levels or if it can get back above 80. But this is one that is at risk of potentially closing out this trade if it doesn't hold above 80. So that's a good example of, when if a trade doesn't work out, what we're trying to do is minimize the amount of risk that we're taking on this specific trade. We added this trade when it was in the 81, 82 range, and if it goes down to around, if it hovers around 76, 77, that would be indication that our thesis is incorrect. So we're risking, 4 or 5 points on the stock, less than that, in exchange for upside, that's into the high 90s, right? So your risk to reward ratio here is easily 3 to 1 on that upside. So, these are the kind of criterias that we look at when identifying ideas to help you kind of start out your week. The next stock we want to take a look at here is NVIDIA. This is one that we added to the stock, as sort of at the end of November here. And, the level that we're really paying attention to here right now is around 130. We added the stock when it was trading around 135. As you can see, it's this double bottom here after breaking out here above 130 is really kind of what gave us the indication of potential support here. And we're looking for that continuation higher here. Now, NVIDIA on paper, it looks like it's trading at a premium valuation relative to its peers. But if you look at their growth metrics, if you look at how profitable they are head and shoulders above their peers. And in my opinion, the premium that it's trading at, about a 50% premium, is still really is still very inexpensive relative to um, its potential. And we know that demand for AI chips likely over the next few years will remain incredibly strong here. They recently just this past quarter started delivering their Blackwell chips. Those are really kind of the primary driver of the future generation of AI. Um, Chips used for AI training and inference. So for those reasons, I think NVIDIA, even though trading at a premium, from a technical perspective, is worth paying attention to here right now, and potentially adding some more bullish exposure if you don't already have it. If you do, potentially adding some more exposure to potentially, hit a home run. Because if you are long NVIDIA, you probably have realized some or have some unrealized gains in this particular stock. Um, Next one I want to take a look at here is Caterpillar. This is a bearish trade that we have here, and this is one that, we added this trade around this 395 level here, and we're looking for that 400 level to hold. So far, it's kind of just holding above that level here. So this is another example of if a stock holds above 400, we would basically close out this particular trade. But what we're basically looking at here is the fact that, as the stock kind of pushed higher here, it lost ground relative to the market, leading us to believe that this breakout here is a false breakout and it's going to pull back into this trading range. Our downside target is around 360, and if you look at valuations from a fundamental perspective, Caterpillar trades at a very, very rich premium relative to its peers. Trades at about a 70% premium relative to its peers from a valuation perspective. And if you look at growth metrics, we're talking about a stock that's growing 1 to 2% per year, both top and bottom line, relatively thin margins. Trading at 17 times forward earnings, 70% premium to the market is quite expensive, and that's part of why we have a bearish thesis here on Caterpillar. Another bearish idea that we have, there's only two that we have at the moment here. Another one is ADI, the semiconductor stock. As you can see, the semiconductors continue to struggle here. ADI also struggling quite a bit here over the last 6 months. Hasn't quite rolled over yet. We're looking for this potentially roll over and kind of continue to trade lower. And it hasn't quite happened yet. But as you can see, it continues to make lower highs and lower lows, which is why we're maintaining our bearish exposure here in ADI. ADI, similar to Caterpillar, trades at a very rich premium relative to its peers, even though it's expected to grow at a rate that's slower than its peers and is not as profitable as its peers. So the fact that it trades at such a premium valuation justifies kind of that downside risk that I currently see here with some of these semiconductor stocks like like Analog Devices that have effectively what is nothing to do with AI. And actually, we're seeing kind of the revenue and EPS trends just simply trend in the wrong direction here for stocks like ADI at the moment. Another one I want to take a look at here is AstraZeneca. Um, we're being pretty careful in some of these stocks that we have that are in the healthcare space, with the incoming administration not particularly keen on this particular industry. I think that there is definitely some caution that you need to take with pharmaceutical type companies here. And AstraZeneca obviously does generate a portion of their revenues using vaccines, even though it's a relatively small portion. That is definitely something that's weighing on the stock. But we noticed that this stock has We added the stock back here in mid-November when it kind of tanked here. We added it pretty much at the very bottom around 63, 64. And what we saw was a stock that was severely oversold and relatively cheap from a valuation perspective, and we were looking for a bounce. And it's exactly what we're getting so far in this particular stock as a bounce. Our upside target here is really in that 75, $76 level here to the upside. So this is a shallower one in terms of upside expectations here, but we're still, about 8, $9 away from our upside target here, 9, $10 away from our upside target here in AstraZeneca. So far playing out nicely based on our outlook. Adobe is one that we currently have in our portfolio that I think is worth paying attention to here right now. I consistently remind people that Adobe is one of the few stocks that actually has an AI product that they are selling and has been selling here for the past few years. They're one of the few stocks that is monetizing an AI product. A lot of companies talk about AI and their future in AI, but they don't actually have a product to sell with regards to AI. Like, for example, Apple is a good example of that. Big tech name talking a lot about AI, but actually don't have an actual product, don't have actually AI built into their products yet. It's coming soon, but Adobe, has been doing this for the last couple of years, and I think that it deserves to trade at a premium valuation, given the fact that they are far more profitable than its peers. They're growing either in line or slightly faster than its peers, yet it trades at a slight discount relative to its peers. So I do think that, the upside potential here for Adobe into that 560 level here, I'm sorry, 580 level here to the upside is a reasonable upside target for Adobe. Square, this is another one that we've had in our portfolio since late October. We added this when it was trading around that $74 level, which was this breakout level that we identified. Um, after it broke out, it kind of came back to retest this level as support a couple of times and then really took off here. And that's really kind of where we maintain a pretty significant upside exposure here in Square. And we believe that there's still a fair amount of upside to go, even though, the stock has obviously rallied quite a bit here. The valuation story that we had back in October is not as compelling it is now. But there's still, in my opinion, some significant upside still left in Square. Another one that we're looking at here is Lululemon. Lululemon here on earnings here last week really took off here, and we're looking for a continuation here. The last gap fill that we have here for Lululemon is here in the 470 range here to the upside. That would be our last upside target. If we can get to 470, that would be a good time to get out of this particular stock. We added the stock when it's trading around 280 or so, and very similar to a lot of the chart setups I've shown you here today. You basically have a stock that was bottoming and started to show some upside potential and has really taken off since we've added it. And we're starting to enter our last leg of our upside potential here for Lululemon. Disney is another one that we added quite a bit ago here. As you can see, after gapping higher here, it's continuing to form that base. Yesterday pulled back a little bit, but our upside target here remains around 125 or so. So we're also getting pretty close to that upside target here, about 10 points away from that on Disney. Um, Meta is another one that we continue to maintain a bullish position here. Meta recently kind of broke out to new highs here as well. And this is really interesting one to pay attention to. It broke out above 600. We're looking for that new base to form above 600 and for it to continue to make another leg higher here. So this is one that even though we added this back here in the beginning of October, if you missed out on it, you still have an opportunity to get back in because the risk reward ratio still remains incredibly strong here. And the valuation still, in my opinion, is incredibly compelling. This is a stock that trades at a pretty substantial discount relative to its peers, even though it's expected to grow much faster. They're significantly more profitable than its peers. And, honestly, one of the things that I continue to lay out is the fact that I think Meta will likely be eating some of Apple's lunch, especially in the AR space over the next few years. Apple spent $100 billion in 10 years building their Vision Pro, and it would be an understatement to say that from a commercial perspective, it really has been underwhelming. They've continued to slash sales expectations multiple times throughout the year. Developers are no longer developing apps for the Vision Pro. At the same time, Meta has released or shown some of their AR products, even though they're not commercially viable like the Vision Pro is. They are clearly, moving in a direction that seems far more commercially viable for consumers. And I think that they're likely moving in a direction that's um, better than Apple, especially as Apple has really fallen behind on both iPhone 16 sales in the AI space, and their kind of next big product here is largely a commercial flop, at least so far. I do think that Apple's valuation at 32 times forward earnings with lower growth and lower profitability than Meta is looking far more riskier, and Meta is trading at that discount about 24 times forward earnings with the upside potential and the faster growth looks far more attractive. So in this type of market environment, I'm much more inclined to be long Meta and short Apple. And those are the opportunities that we see here for the overall market. And please, I hope that you guys find this useful in giving you a better understanding of where we currently stand in the overall market, and more importantly, some of the key ideas that we currently maintain in our list at the moment that provides us with opportunities here in the market. With that, thank you so much. I hope you guys have a great trading week, and I'll see you guys here next week.